Here we have another company who took too much risk and it came back to haunt them. This should be a lesson to everyone to also be prepared for the worst. Aim to do well. Try to achieve gains. Do your best, but don't over leverage. Don't push the limits because there are always strategies of leverage that can break down rapidly, and this is one extreme example. You came here for the truth, so let me unveil that for you. Today we're going to talk further about Archegos. I did a full video on it yesterday, and I will link to that at the end of this one. But I want to break down a little bit further into it, give people some more insight. But as I said, that other video really covered top to bottom of what we know so far. I want to highlight that, but I also want to look at what's happening. You know, there's more of this stimulus coming through. They're talking about it. We're seeing the Federal Reserve and what they have to say about inflation right now. I've got some information on that. I've got a lot of information, in fact, that I don't think I can get to it all, but I'll try my best. So let's go. A little bit more of the backstory here. Meet Bill Hwang, the man behind Archegos, the fund that sent shockwaves through Wall Street. I use this quote right here, this word, shockwaves, and I had a comment saying, "There are no shockwaves, you're a liar." Anyway, these are just quotes, but here we go. So you have Archegos is a family investment vehicle founded by former Tiger management analyst Bill Hwang in 2013. Hwang was a protege and one of the so-called Tiger Cubs of legendary hedge fund manager Julian Robertson. So this person isn't just out of nowhere. This is somebody that came up and, you know, as they say right here, 2012, he pleads guilty to insider trading. And here you have a person who had some prominence, gets in trouble, and then next year, he basically opens up this new company and they're doing business. As I mentioned in the previous video, you had some certain companies, I think it was Goldman Sachs, who basically was shying away from him at first, saying, no, we don't want to deal with that. But I guess the gains were too good and then they got in. Now they might be burned as a result of that. So we're just seeing this. I wanted to highlight it for you to give you a little bit more of a broad perspective and not just say, you know, there's some random hedge fund or whatever you want to call it out there. No. We're looking at this and sort of trying to realize how many other players are out there that are doing the same thing. And that brings me into this Bloomberg article. What happens now? Traders around the world are on high alert as they wait to see whether more block trades come through and if the fire sale by Hwang's family office will have a fallout on the wider financial system. As I have said specifically, we do not know at this point. We are still in the wait and see moment. Clearly, there are some direct losses that have been experienced by Credit Suisse and others. And, you know, we're going to have to find out what happens. Questions are also being asked about why so many big banks lent so much money to a family office whose founder had a checkered past. And, you know, it's funny because they always do this. There's individuals who are constantly up to no good. And what do? They get a slap on the wrist, and that's all. Or you've got a company who's notorious for certain activities. You know, you replace the CEO, you shuffle the people around a bit, and now they seem as if they've done something great, but ultimately it's the same bunch of people. Replace a name, it's all the same. On Monday, Nomura warned of a significant potential loss from a unnamed U.S. client said to be Archegos, and that, of course, we know covered in the previous video. Like I said, we're going to have to wait for more details. Then at the bottom right here, you can see there are also questions about whether there is more pain ahead for other hedge funds. Many have exposure to the same basket of stocks as Hwang's family office, and with the US economy rebounding, some of the speculative capital that plowed into Chinese shares is exiting. We also saw Viacom CBS that was plummeting like crazy. You know, you had a bunch of other names. I showed you a chart in the previous video, and ultimately we will see how widespread that is. There are a couple good points in this article here. I just want to touch on a few. What might be the largest margin call in history is ringing fresh alarm bells on Wall Street among those worried about hidden leverage, and its potential to fry the financial system. Now, this isn't the money GPS, but it sounds a lot like things I would say. And this is the truth because, you know, you can take what they give you at face value and they say everything is just fine, and Jim Cramer is out there trying to tell you to buy everything. But you got to know that eventually when you have these monetary systems ultimately devaluing their currency the way that they do, you have these massive holes that appear, and they take people with it. I mean, that's just an inevitable fact. So here you can see just more detail, the forced selling of more than $20 billion of apparently swap-linked shares at Archegos has set off a hunt for other areas of excess, from margin debt to options and bloated balance sheets, after stocks at the center of the fiasco plunged and investment banks warned of losses. So there's definitely more to this. And I just want to note this one last thing before we move on. I want to take it more in depth, of course, but certainly there's just not enough time to get to everything. As with most things in the markets, opinions vary. Hwang's travails are portrayed as everything from phase one of a long overdue market comeuppance to an isolated case of risk-taking run amok, while Wall Street may have sidestepped a systemic cataclysm. Love the words this guy's using here. The blow up is an example of leverage gone wrong. And that's the title that they used of this article here. And I think it's important to know that. Leverage gone wrong. You know, you think about what has happened here throughout this period. 2008, they told you that they made the market safer, but they didn't. So maybe today you don't have as many CDOs, but are you aware that the CLOs really came to pick up the slack? And they've got everything really that they need to create things out of thin air. Call them whatever. I don't care what letter of the alphabet you use. It doesn't matter. It's all a bunch of garbage. And I'll keep saying that because it's the absolute truth. This guy was able to create something out of nothing and sell it to these companies. And then when you have some very minor change that occurs, it just throws the whole thing out the window. Common practice for the ultra rich, committing shares is common practice. And with tens of millions of dollars in fees at stake, it's hard for banks to say no to a practice that typically has plenty of safeguards in place and represents only a fraction of the value of the pledged shares. So they mention here Larry Ellison, Elon Musk, and it goes on. Larry Chen, who lost more than $3 billion on Friday when his GSX Inc. dropped amid the equity sales, also had pledged shares, though a company representative said that he paid off his loan in last year's third quarter and hasn't committed any stock since. And it basically goes on. Now, you can look at this and realize that, hey, there's probably a lot more companies and individuals that are part of this. So we're going to see what happens. This article here is talking about Credit Suisse and the losses that they are taking. I just want to note this right here. Shares in the Swiss bank fell another 2% as investors estimate the scale of the damage. Its shares are now down 10%. So we're in correction territory for the year, even as UBS shares have risen 15%. So it's not just, the broad index. Clearly, there's something going on with this stock, and there's more than just this one event. They were also implicated here, as you see in this article. Credit Suisse late last year agreed to extend a $140 million loan to Greensill Capital just months before its collapse. This is something that I was covering recently, touched on it in a few videos, but you can see that a few in a row certainly hurts this investment institution. So we're going to see how they respond to that. Hey, if they want to get that stock up and rising, all they need to do is fire, 5 or 10% of the staff, and hey, the stock market will love it. Credit Suisse 1-year CDS, you could see right now, counterparty risk hedge, people are getting in to see that, you've got a problem. And anytime that's the case, you might have some CDS piling in. That's the way that Greece was really torn down, some say, by everybody pumping up these CDSs. And look at that. Just over the past few days, essentially, this has really risen. turning the page here, I mean, I think it's important to note all of this information and understand why these things happen. It's because of the excessive risk taking by the central banks. They are the ones taking the risk, and essentially people just fall in line. That's the way that investors and individuals, whether it comes from the institutional or the retail, you drop interest rates, you pump in money from every direction, you're going to have risk taking. And this is the Dallas Fed president, Robert Kaplan, saying that he takes a position different than the median among Fed officials on interest rate hikes, and that he will be advocating that we should be taking action once benchmarks for employment and inflation are met. Hey, I mean, obviously this individual works within the Fed system, but at least he's talking about some reality that when you go to a certain level, whatever that is, 2%, or is it 2.5 now? Nobody even knows what they want. When it hits that level, okay, now let's start talking about increasing interest rates. But the average, not just Jerome Powell, but the average voting member are all saying, oh no, we have no plan on increasing rates at all. I mean, it doesn't matter what inflation's doing. We're not going to increase rates at all. I mean, it's crazy. It's really crazy to see that. And he has a few other quotes in here that I thought were interesting, but to me, that's really what's happening. You've got the Federal Reserve as an institution in itself basically ignoring the information that's coming through. And that, to me, it shows you the criminal intent that this organization is really up to. I can't believe my eyes, but there is more and more stimulus coming through in every direction. Apparently, another $4 trillion in infrastructure with massive tax hikes are coming through. But don't worry, it's only going to be on the wealthy people, right? Absolutely not. $4 trillion on top of the 1.9 trillion, on top of the trillions that were pumped out before that, on top of everything that was already in place, within the last few months before that. You're talking about debt that can never, absolutely never be paid off. You increase the taxes, it won't do anything. There's no way. You can't pay off this debt. So what do? You monetize it, and you get the central bank to buy it all up, and you will see what happens when the confetti rains from the skies. This comes from the Fund Manager Survey, Bank of America. 2% on the 10-year Treasury could be the level of reckoning for stocks. We'll see what happens, of course, nobody knows, but this is coming as of March, and you're seeing right now that people believe that's the case. You're watching it rise to levels it hasn't been at in a long time. We will see as a result of all of this. Nobody really knows because of so much stimulus, because of all the QE. It's kind of obscuring all the details. But certainly, let's keep our eyes on the bond market because it is very telling. Really quick note here, you can see Wells Fargo plans for a return to the office soon after Labor Day. Of course, they don't know anything. Of course, none of these companies know anything because it seems to be changing all the time, but we'll see what happens. This is good news for the economy in general because if Wells Fargo's going back, the other companies, the little businesses around them, finally will have some people coming in and out, buying, sandwiches and going to their corner stores and maybe doing a little shopping on their lunchtime and so on. So we'll see what happens as these businesses do go back to work, how the economy is able to then find its way to a resurgence, but only time will tell. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that by clicking on your screen. One button, you help me out. Thank you very much. I also want to thank everybody who has donated to me from anything from the cryptos, to the PayPal and the Patreon and so on, and actually on Brave as well, the Brave browser. I want to thank everybody for that. Truly helps me out a lot. Thank you. If you want to learn about e-commerce, I created this course for my subscribers to learn how to sell stuff online. And I did it for free. I made it for you. You can check it out at the AmazonGPS.com. Do you want to understand the financial system from top to bottom? You can learn right here in these two books. It's explained so easily. You definitely want to check them out. you can go to the link in the description and you'll be able to flip through the pages for of these books for yourself. Have you seen this video yet? This is the one I talked about Archegos. I gave you the whole download, the whole detail you need to know. So you can click it and I'll see you there.